Chapter 2, Introduction to Securities Market. Learning Objectives. After studying this chapter, you should know about meaning of securities and the functions of securities market, various kinds of products in securities market, structure of securities market, activities of the securities market participants, various securities market transactions, dematerialization and rematerialization of securities, introduction to securities and securities market. Securities are transferable financial instruments or contracts that show evidence of indebtedness or ownership interest in assets of an incorporated entity. These include equity shares, preference shares, debentures, bonds, and other such instruments. These are issued by companies, financial institutions, or the government. They are purchased by investors who have money to invest. Security ownership allows investors to convert their savings into financial assets which provide a return. On the other hand, security issuance allows borrowers to raise money at a cost. Thus, the objectives of the issuers and the investors are complementary. Raising funds through issue of securities also allows the investors to transfer their rights/interests to others without impacting the issuers. Thus, securities also provide a mechanism for issuers to raise money for long-term while providing an opportunity to the investors to exit. The efficacy of security in allowing movement of capital is achieved through an efficient securities market that allows investors and sellers to buy and sell securities. Securities market brings together a large number of buyers and sellers and thus creates liquidity, that is, makes it easy to buy and sell securities at close to market prices. These markets help in transfer of resources from those with idle or surplus resources to others who have a productive need for them. To state formally, securities market provides channels for conversion of savings into investments. Through securities market, a broader universe of savers with surplus to invest is available to the issuers of securities, and a universe of wider options is available to savers to invest their money. Broadly stating, financial market consists of investors/providers of funds, buyers of securities, borrowers/seekers of funds, sellers of securities, intermediaries providing the infrastructure to facilitate transfer of funds and securities, regulatory bodies responsible for orderly development of the market. The term securities has been defined in Section 2H of the Securities Contracts Regulation Act, 1956 SCRA. The term securities include 1. Shares, scrips, stocks, bonds, debentures, debenture stock, or other marketable securities of a like nature in or of any incorporated company or a pooled investment vehicle or other body corporate. 2. Derivative. 3. Units or any other instrument issued by any collective investment scheme to the investors in such schemes' units. 4. Security receipt as defined in Clause ZG of Section 2 of the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, 2002. 5. Units or any other such instrument issued to the investors under any mutual fund scheme. Explanation. For the removal of doubts, it is hereby declared that securities shall not include any unit-linked insurance policy or scrips or any such instrument or unit by whatever name called, which provides a combined benefit risk on the life of the persons and investment by such persons and issued by an insurer referred to in Clause 9 of Section 2 of the Insurance Act, 1938, 4 of 1938. 6. Units or any other instrument issued by any pooled investment vehicle. 7. Any certificate or instrument, by whatever name called, issued to an investor by an issuer being a special purpose distinct entity which possesses any debt or receivable including mortgage debt, assigned to such entity and acknowledging beneficial interest of such investor in such debt or receivable including mortgage debt as the case may be. 8. Government securities. Such other securities as may be declared by the central government to be securities and rights or interest in securities, for example, electronic gold receipts, are declared as securities via Gazette notification dated December 24, 2021. Electronic gold receipt means an electronic receipt issued on the basis of deposit of underlying physical gold in accordance with the regulations made by the Securities and Exchange Board of India under Section 31 of the said Act. The investors in the Indian securities market have a wide choice of financial products to choose from depending upon their risk appetite and return expectations. Broadly, the financial products can be categorized as equity, debt, and derivative products. We shall learn more about these securities in detail in the next section. Product definitions/terminology. There are many financial instruments issued in the market, each with distinct risk and return characteristics that define its suitability for an investor. In this section, we shall explore the major instruments available in the Indian securities market. Equity shares, issued by companies or issuers. Investors, institutional, FPI, FII, DII, and individual, retail, and HNI. Medium, direct issuance by companies and stock exchange. Regulator, SEBI, regulators under the Companies Act. Equity shares represent the form of fractional ownership in a business venture. Equity shareholders collectively own the company. They bear the risk and enjoy the rewards of ownership. Debentures, bonds, notes. Issued by companies, government, special purpose vehicles, SPVs, other issuers. Investors, institutional and individual. Medium, direct issuance by issuers and stock exchange if listed. Regulator, RBI, SEBI, regulators under the Companies Act. Debentures, bonds, notes are instruments for raising long-term debt. Debentures are either unsecured or secured, backed by collateral support in nature. There are a variety of debentures/bonds such as fully convertible, non-convertible, and partly convertible debentures. These could be in domestic as well as foreign currency. Fully convertible debentures are fully convertible into ordinary shares of the issuing company. The terms of conversion are specified at the time of issue itself. Partly convertible debentures, PCDs, are partly convertible into ordinary shares of the issuing company under specified terms and conditions as specified at the time of issue itself. The non-convertible part of these debentures is redeemed as happens in any other vanilla debenture. Non-convertible debentures, NCDs, are pure debt instruments without a feature of conversion. The NCDs are repayable/redeemable on maturity. Thus, debentures can be pure debt or quasi-equity as the case may be. We would discuss about these types in section 2.2.7 in further detail. Further, short-term debt instruments are used to raise debt for periods not exceeding 1 year. These instruments include treasury bills issued by the government, commercial papers issued by the companies, and certificate of deposit issued by the banks. Foreign currency bonds, issued by companies, government, special purpose vehicles, SPVs. Investors, institutional and individual. Medium, direct issuance by issuers and stock exchange. Regulator, regulators in the respective country of issue. Foreign currency bonds are bonds issued by a company in a currency that is different from the currency of its home country. For example, in February 2020, Delhi International Airport Limited, an SPV of GMR Infrastructure Limited, issued USD bonds. These could also have a feature of conversion into shares if needed based on preferences of issuers/investors. Companies in emerging markets may prefer to issue bonds in USD or currencies of other economically matured countries as they carry significantly lower interest rates. However, these bonds create significant foreign currency risk to the issuer. In case of the foreign currency of issue of the bond appreciates against the local currency, the issuer will need higher amount of local currency to repay the loan. External bonds/Masala bonds, issued by companies, government, special purpose vehicles, SPVs. Investors, institutional and individual. Medium, direct issuance by issuers and stock exchange. Regulator, regulators in the respective country of issue. External bonds, also referred as Eurobonds, are bonds issued in a currency that is different from the currency of the country in which it is issued. For example, if a company issues a US dollar-denominated bond in Kuwait, it would be referred as a Eurobond as the currency of the bond, USD, is different from the currency of the country in which it is issued, Kuwaiti dinar. External bonds denominated in Indian rupees, INR, are referred as Masala bonds. These bonds are issued outside of India but are denominated in Indian rupees. Masala bonds were issued for the first time in November 2014 by International Finance Corporation and was listed in the London Stock Exchange. As against foreign currency bonds, which create currency risk for the issuer, in the case of Masala bonds, the currency risk is borne by the investor. Since the bonds are denominated in INR, if INR depreciates against the currency of the country of issue, the amount received by the investor will be less in their local currency terms. Warrants and convertible warrants, issued by companies. Investors, institutional and individual. Medium, direct issuance by companies and stock exchange. Regulator, SEBI. Warrants are options that entitle an investor to buy equity shares of the issuer company after a specified time period at a predetermined price. Only a few companies in Indian securities market have issued warrants till now. Indices. A market index tracks the market movement by using the prices of a specific number of shares chosen as a representative sample. Most leading indices are weighted by market capitalization to take into account the fact that more the number of shares issued, greater the number of portfolios in which they may be held. Stocks included in an index are also quite liquid, making it possible for investors to replicate the index at a low cost. Narrow indices are usually made up of the most actively traded equity shares in that exchange. Other indices to track sectors or market cap categories are also in use. The most widely tracked indices in India are the NSE's Nifty 50, S&P BSE Sensex, and MSCI's SX40. The S&P Sensex has been computed as the market cap weighted index of 30 chosen stocks on the BSE. The SX40 is composed of 40 most representative stocks listed on Metropolitan Stock Exchange of India Limited, MSEIL, and the Nifty 50 is composed of 50 most representative stocks listed on the National Stock Exchange. The shares included in these indices are chosen on the basis of factors such as liquidity, availability of floating stock, and size of market capitalization. The composition of stocks in the index is reviewed and modified from time to keep the index representative of the underlying market. Some of the other common indices in India are listed below. Nifty Next 50, Nifty 100, Nifty 500, S&P BSE 100, S&P BSE 500, S&P BSE Midcap, S&P BSE Small Cap. There are also sector indices for banking, information technology, pharma, fast-moving consumer goods, and such other sectors created by the exchanges to enable tracking specific sectors. The major uses of indices are: the index can give a comparison of returns on investments in stock markets as opposed to asset classes such as gold or debt. For the comparison of performance with an active equity fund/portfolio, a stock market index can be the benchmark. The performance of the economy or any sector of the economy in a country is indicated by the index. Real-time market sentiments are indicated by indices. Indices act as an underlying for index funds, index futures, and options. Mutual fund units. Issued by mutual funds. Investors, institutional and individual. Medium, direct issuance by mutual funds and stock exchange. Regulator, SEBI. Mutual funds, MFs, are investment vehicles that pool together the money contributed by investors, which the fund invests in a portfolio of securities that reflect the common investment objectives of the investors. Each investor's share is represented by the units issued by the fund. The value of the units, called the net asset value, NAV, changes continuously to reflect changes in the value of the portfolio held by the fund. MF schemes can be classified as open-ended or closed-ended. An open-ended scheme offers the investors an option to buy units from the fund at any time and sell the units back to the fund at any time. These schemes do not have any fixed maturity period. The units can be bought and sold anytime at the NAV-linked prices. The unit capital of closed-ended funds is fixed and they sell a specific number of units. Units of closed-ended funds can be bought or sold in the stock market where they are mandatorily listed. Exchange-traded funds, ETFs. Issued by mutual funds. Investors, institutional and individual. Medium, direct issuance by mutual funds and stock exchange. Regulator, SEBI. Exchange-traded fund, ETF, is an investment vehicle that invests funds pooled by investors to track an index, a commodity, example, gold, or a basket of assets. It is similar to an index fund in the sense that its portfolio reflects the index it tracks. But, unlike an index fund, the units of the ETF are listed and traded in demat form on a stock exchange, and their price changes continuously to reflect changes in the index or commodity prices. ETFs provide the diversification benefits of an index fund as well as the facility to sell or buy at real-time prices, even one unit of the fund. Since an ETF is a passively managed portfolio, its expense ratios are typically lower than those of a mutual fund scheme. Hybrids/structured products. Preference shares. Preference shares, as their name indicates, are a special kind of equity shares which have preference over common/ordinary equity shares at the time of dividend and at the time of repayment of capital in the event of winding up of the company. They have some features of equity and some features of debt instruments. Preference shares resemble equity as preference shareholders are called shareholders of the company, not creditors. Payment to them is termed as dividend, and the same is paid from the profit after tax, and dividend payment is not an obligation, unlike interest. However, unlike common equity shares, preference shares do not carry voting rights or right over the residual assets of the company in case of winding up. Preference shares resemble debt instruments because they offer predetermined rate of dividend, and this dividend is payable before any dividend is paid on common equity. Further, in case of winding up of the company, preference shareholders get paid before common equity holders. In other words, these shareholders have preference over the common equity holders at the time of distribution of both earnings and assets. There are a variety of preference shares. Cumulative unpaid dividend is carried forward, non-cumulative unpaid dividend lapses, convertible partly or fully, etc. Convertible debentures and bonds. Convertible debentures are debt instruments that can be converted into equity shares of the company at a future date. This security also has features of both debt and equity. It pays periodic coupons/interest, just like any other debt instrument, till conversion. And at a predefined time, this debt instrument may get converted into equity shares. These debentures may be of different kinds. Fully convertible debentures (FCD), where the entire face value of the debenture is converted into equity shares. Partly convertible debentures (PCD), where a portion of the debenture is converted into equity. The non-convertible portion continues to remain as debentures, earns interest income, and gets repaid on redemption. Optionally convertible debentures (OCDs). OCDs are convertible into equity shares at the discretion of the debenture holders, who may choose to convert them into equity or continue to hold the instrument as debt, depending on their desire and the terms of conversion. The issuer specifies the details of the conversion at the time of making the issue itself. These will generally include date on which or before which the conversion may be made, ratio of conversion, that is, the number of shares that the investor will be eligible to get for each debenture, price at which the shares will be allotted to the investor on conversion. Usually, this is at a discount to the market price. Proportion of the debenture that will be converted into equity shares in case of partially convertible debentures. The advantage to the issuer of convertible debenture lies in the fact that convertible debentures usually have a lower coupon rate than pure debt instruments. This is because the yield to the investor in such debenture is not from the coupon alone but also the possibility of capital appreciation in the investment once the debentures are converted into equity shares. Moreover, the issuer does not have to repay the debt on maturity since shares are issued in lieu of repayment. The disadvantage to this is that stakes of the existing shareholders get diluted when fresh shares are issued on conversion. As more shareholders come in, the proportionate holding of existing shareholders falls. The investors in a convertible debenture have the advantage of equity and debt features. They earn coupon income in the initial stage, usually when the company's project is in its nascent stage. And once the debenture is converted into shares, they may benefit from the appreciation in the value of the shares. Indian Depository Receipts, IDRs, Global Depository Receipts, GDRs, and American Depository Receipts, ADRs. Depository receipts, DRs, are financial instruments that represent shares of a foreign company. These depository receipts trade in the local market in which it is issued and are denominated in local currency. The process of issuing a depository receipt is as follows. 1. A company or an investor delivers a specific quantity of equity shares to a bank. 2. The bank places the security in its custodian account in the country where the company is domiciled. 3. The bank then issues a certificate, depository receipt, against such shares to investors in the overseas market. If the issuing company is the one that delivers the securities and initiates the process, it is referred as sponsored depository receipts, and they can be listed in the exchanges of the country in which the DRs are issued. Companies that want their DRs to be listed should apply for listing and should comply with all the listing requirements. On the other hand, if the shares are delivered by an investor, they are referred as unsponsored depository receipts. Typically, unsponsored DRs are not allowed to be traded in the stock exchanges. They can be traded only in OTC markets. They also have less regulatory requirement. DRs may feature two-way fungibility subject to regulatory provisions of the countries involved. This means that shares can be bought in the local market and converted into DRs to be traded in the foreign market. Similarly, DRs can be bought and converted into the underlying shares, which are traded on the domestic stock exchange. Indian companies are permitted to raise foreign currency resources in the form of issue of ordinary equity shares through depository receipts. Foreign companies are also allowed to raise equity capital from India through IDRs. SEBI has laid down the guidelines to be followed by companies for IDRs. These include the limit on the money raised by a company in India, 1-year lock-in on the conversion of IDRs into shares, the availability of IDRs to only resident Indian investors, etc. Several stock exchanges around the world allow trading in depository receipts of a foreign company. These depository receipts can be specific to a country or it can be traded across multiple countries, as in case of GDRs. Some of the country-specific depository receipts include American Depository Receipts, ADRs. These depository receipts issued and traded in USA that are issued by a non-US company. ADRs are one of the most popular depository receipts, and many companies across the world have issued ADRs. Some of the Indian companies that have issued ADR include Infosys, Wipro, ICICI Bank, and HDFC Bank. The American exchanges have allowed ADR since the early part of 20th century, and thus it is one of the most evolved markets. Indian Depository Receipts, IDR. D are issued and traded in the Indian market by a non-Indian company is referred as IDR. Depository receipts of Standard Chartered Bank are traded in Indian stock market in the form of IDR. Hong Kong Depository Receipts, HKDR. In the same lines as the above two, HKDRs refer to depository receipts issued by a non-Hong Kong company that are traded in the Hong Kong market. Global Depository Receipts, GDRs. These refer to depository receipts that are allowed to be traded in more than one country. Typically, GDRs are preferred to be issued in the European Union member states as commonality of the regulations makes it easy for the issuing companies to comply with regulations across the region. The company whose shares are traded as DRs gets a wider investor base from the international markets. Investors in international markets get to invest in shares of the company that they may otherwise have been unable to do because of several restrictions or administrative issues. Investors get to invest in international stocks through domestic exchanges with their existing brokers and local currency. Holding DRs give investors the right to dividends and capital appreciation from the underlying shares, but no voting rights. However, issue of voting rights to DR holders is under consideration of SEBI at present. Foreign Currency Convertible Bonds, FCCBs. FCCBs, or Foreign Currency Convertible Bonds, are foreign currency, usually dollar-denominated convertible debt papers issued by companies in international markets. These instruments are to be understood the way convertibles are, with only difference that they are generally optionally convertible and issued offshore in different denomination under guidelines as defined by Reserve Bank of India, RBI. From time to time, the payment of interest and repayment of principal, if happens on these bonds, is in foreign currency. However, once conversion of instrument happens in equity, dividend is paid in Indian rupees with conversion obligation, currency risk, lying with the investors. FCCBs are regulated by RBI notifications under the Foreign Exchange Management Act, FEMA. The issue of foreign currency convertible bonds and ordinary shares through Depository Receipt Mechanism 1993 lays down the guidelines for such issues. Equity-linked debentures, ELDs. Equity-linked debentures, ELDs, are floating-rate debt instruments whose interest is based on the returns of the underlying equity asset, such as Nifty 50, S&P Sensex, individual stocks, or any customized basket of individual stocks. The issuer of bond invests a predetermined part of the principal amount collected in fixed-income securities like bonds, which provide principal protection, while the balance is used to buy options which provide the exposure to returns of equity. Thus, these instruments are generally structured in a way to give full capital protection with a provision for equity participation to the investors. Capital protection should not be read as non-existence of credit risk of default by issuer. These instruments still carry credit risk and accordingly rated by credit rating agencies. Commodity-linked debentures, CLDs. Just like ELDs, CLDs are floating-rate debt instruments whose interest is based on the returns of the underlying commodity asset. While the returns can be linked to any commodity, most of these papers globally are linked to precious metals, gold, and silver. Like ELDs, the advantage of CLDs is that they provide the investor an opportunity to earn return from the commodity markets while protecting their initial capital. Mortgage-backed securities, MBS, and asset-backed securities, ABS. MBS and ABS are debt instruments issued by institutions against the receivables and cash flows from financial assets such as home loans, MBS, auto loans, rent receivable, credit card receivables, and others. The cash flows accruing from these assets are used to meet the interest and principal repayment obligations on the bonds issued. The issuer is able to create liquidity in an otherwise illiquid asset by securitizing them. The instruments are credit-rated and may be listed on stock exchanges. Financial innovation is a continuous process and new products keep hitting financial markets on a day-to-day basis. REITs/INVITs, Real Estate Investment Trust, REITs, and Infrastructure Investment Trusts, INVITs, are investment vehicles that pool money from various investors and invest in revenue-generating real estate projects and infrastructure projects, respectively. As the name indicates, these vehicles are formed as a trust. They issue units to the investors to raise money. They enjoy favorable tax treatment as long as they meet the necessary regulatory requirements. Regulations stipulate the minimum amount of the assets that have to be held in the form of revenue-generating assets. In the case of REITs, 80% of the assets should be held in the form of real estate assets. Similarly, for INVITs, regulation stipulates that 90% of the unit capital should be invested in revenue-generating infrastructure projects. These assets can be held directly or through a special purpose vehicle, SPV. In the case of both REITs and INVITs, the trust has to distribute at least 90% of the distributable surplus cash flow to the unit holders. Commodities. Commodities are basic materials or goods that are largely homogeneous in nature. These goods are interchangeable with other goods of the same type. Thus, a bar of gold is a commodity while a jewelry made of the gold is not a commodity. This is because an investor would be indifferent to different bars of gold as long as their quantity and quality remain same. However, in the case of jewels, the buyer may prefer one design over another even though their weight and quality may be the same. Commodities may be hard or soft. Hard commodities are essentially natural resources that are mined or extracted. This includes all types of metals and crude oil. Soft commodities, on the other hand, refer to commodities that are grown, that is, agricultural products. Soft commodities include grains and pulses. Commodities are largely traded goods that are meant for use in production of goods or for consumption. Since inflation and prices of commodities are directly related, investing in commodity can help protect real value of investment. However, most of the commodities involve huge storage costs and are thus not suitable investments. Having said that, there are certain avenues available to invest in commodities. Precious metals. Precious metals such as gold and silver are viewed as an investment that can help preserve real value of money. Unlike many other commodities that have short life, these precious metals have very long life. Further, storage cost on these metals is very small compared to their values. These characteristics make precious metals a viable investment option. Commodity ETFs. Commodity ETF is an exchange-traded fund that invests the pooled investment in a range of physical commodities. Investors can invest in commodity ETF by buying the units of the fund. The value of the units largely moves in line with the net asset value of the fund, which, in turn, moves in line with the commodity prices. Since the storage is handled by the fund, the investors do not have any storage obligation. Although commodity ETFs can be created for any set of commodities, gold ETFs are the most common commodity ETF products as they are easy to store and manage for the fund. Managed futures contract. Futures contract is a contract to buy or sell an asset at specified future date at a specific price. Since the price of the contract is predetermined, the buyer of the contract tends to gain if the price of the product increases in future. The reverse is also true. Thus, an investor can gain out of price rise without buying the product. Managed futures contract refers to a portfolio of futures contracts that are actively managed by professionals. Instead of buying the actual underlying asset, the investment managers take position in the futures contract. Investors can thus invest in commodities through managed commodity futures contracts. Warehouse receipts. Warehouse receipt is a document that shows proof of ownership of goods that are stored in a warehouse. Most of these warehouse receipts are negotiable. Thus, the title to the underlying goods can be transferred by simply transferring the receipts. Structure of securities market. The market in which securities are issued, purchased by investors, and subsequently transferred among investors is called the securities market. The securities market has two interdependent and inseparable segments. Primary market. The primary market, also called the new issue market, is where issuers raise capital by issuing securities to investors. Fresh securities are issued in this market. Secondary market. The secondary market facilitates trades in already issued securities, thereby enabling investors to exit from an investment or new investors to buy the already existing securities. The primary market facilitates creation of financial assets, and the secondary market facilitates their marketability/tradability, which makes these two segments of financial markets interdependent and inseparable. We shall look at each of the markets in detail in the next section. Ways to issue securities. Primary market. As stated above, primary market is used by companies, issuers, for raising fresh capital from the investors. Primary market offerings may be a public offering or an offer to a select group of investors in a private placement program. The shares offered may be new shares issued by the company, or it may be an offer for sale where an existing large investor/investors or promoters offer a portion of their holding to the public. Let us understand various terms used in the primary market. Public issue. Securities are issued to the members of the public, and anyone eligible to invest can participate in the issue. This is primarily a retail issue of securities. Initial public offer, IPO. An initial public offer of shares or IPO is the first sale of a corporate's common shares to investors at large. The main purpose of an IPO is to raise equity capital for further growth of the business. Eligibility criteria for raising capital from the public investors is defined by SEBI in its regulations and include minimum requirements for net tangible assets, profitability, and net worth. SEBI's regulations also impose timelines within which the securities must be issued and other requirements such as mandatory listing of the shares on a nationwide stock exchange and offering the shares in dematerialized form, etc. SEBI regulation also specifies the proportion of shares to be allocated to different classes of shareholders. According to it, in an eligible issue, at least 35% of shares should be allocated to retail investors investing less than or equal to Rs 2 lakh in the issue, while at most 50% can be allocated to qualified institutional investors. Other investors can be issued the balance. In 2009, SEBI also introduced the concept of anchor investor. Anchor investor means a qualified institutional buyer who makes an application for a value of 10 crore rupees or more in a public issue made through the book building process. Anchor investors can be allocated up to 60% of the portion allocated to QIBs. Bidding for them opens one day before the IPO opens for public subscription. However, the allocation price for anchor investors can be lower than the final issue price determined through the book building process. The volume and value of anchor subscriptions serve as an indicator of the quality of the offer. Follow-on public offer, FPO. When an already listed company makes either a fresh issue of securities to the public or an offer for sale to the public, it is called FPO. When a company wants additional capital for growth or desires to redo its capital structure by retiring debt, it raises equity capital through a fresh issue of capital in a follow-on public offer. A follow-on public offer may also be through an offer for sale, which usually happens when it is necessary to increase the public shareholding in the company to meet the regulatory requirements. Private placement. It refers to issuing large quantity of shares to a select set of investors. According to Companies Act 2013, the number of investors to whom shares are issued under private placement should not exceed 50. Private placements can be in the form of qualified institutional placements, QIP, or preferential allotment. Qualified institutional placements, QIPs. Qualified institutional placement, QIP, is a private placement of shares made by a listed company to certain identified categories of investors known as qualified institutional buyers, QIBs. QIBs include financial institutions, mutual funds, and banks, among others. SEBI has defined the eligibility criterion for corporates to be able to raise capital through QIP and other terms of issuance under QIP such as quantum and pricing, etc. Preferential issue. Preferential issue means an issue of specified securities by a listed issuer to any select person or group of persons on a private placement basis and does not include an offer of specified securities made through a public issue, rights issue, bonus issue, employee stock option scheme, employee stock purchase scheme, or qualified institutions placement, or an issue of sweat equity shares or depository receipts issued in a country outside India, or foreign securities. The issuer is required to comply with various provisions defined by SEBI, which inter alia include pricing, disclosures in the notice, lock-in, in addition to the requirements specified in the Companies Act. The requirements of SEBI's regulations with respect to a public issue do not apply to a private placement. A privately placed security can be listed on a stock exchange provided it meets the listing requirements of SEBI and the stock exchange. Private placement of securities can be done by a company irrespective of whether it has made a public offer of shares or not. Rights and bonus issues. Securities are issued to existing shareholders of the company as on a specific cut-off date, enabling them to buy more securities at a specific price, in case of rights, or without any consideration in case of bonus. Both rights and bonus shares are offered in a particular ratio to the number of securities held by investors as on the record date. An investor who has been awarded right shares has three options: 1. Exercise the right. 2. Transfer the right to another investor. Or 3. Let the rights lapse, that is, do nothing. On the other hand, in case of bonus, additional shares are conferred on to the existing shareholders without any consideration in lieu of dividends. Companies can issue bonus shares only if they have sufficient amount of retained earnings. When a bonus issue is made, an amount equivalent to the value of the shares issued should be transferred from retained earnings to share capital. Onshore and offshore offerings. While raising capital, issuers can either issue the securities in the domestic market and raise capital or approach investors outside the country. If capital is raised from domestic market, it is called onshore offering, and if capital is raised from the investors outside the country, it is termed as offshore offering. Offer for sale, OFS. An offer for sale, OFS, is a form of share sale where the shares offered in an IPO or FPO are not fresh shares issued by the company but an offer by existing shareholders to sell shares that have already been allotted to them. An OFS does not result in increase in the share capital of the company since there is no fresh issuance of shares. The proceeds from the offer go to the offerers, who may be promoters or other large investors. The disinvestment program of the Government of India, where the government offers shares held by it in public sector undertakings (PSUs), is an example of OFS. It may be stated that OFS is a secondary market transaction done through the primary market route. Sweat equity. Under Section 54 of the Companies Act, 2013, a company may issue shares to its employees, promoters, technocrats, or others as reward for their contribution to the company. These shares are referred as sweat equity. The purpose of issuing the share is to motivate employees and top management or any other recipient to work in the interest of the company. It helps reduce the agency risk arising on account of separation of management and ownership. Although the main purpose of sweat equity is not to raise capital, the transaction does involve issuing new shares. Employee Stock Option Scheme, ESOPs. ESOPs are instruments given by a company to its employees that give them an option to buy the shares of the company at predetermined price after a period of time, referred as vesting period. Typically, the vesting period is more than 1 year, and companies may stipulate additional conditions for vesting. Like sweat equity, the objective of issuing ESOPs is to motivate employees to work in the interest of the company. The employees gain only if company's share price rises above the exercise price of the option. The company will have to issue shares if the employee chooses to exercise the option. Secondary market. While the primary market is used by issuers for raising fresh capital from the investors through issue of securities, the secondary market provides liquidity to these instruments. An active secondary market promotes the growth of the primary market and capital formation, since the investors in the primary market are assured of a continuous market where they have an option to liquidate/exit their investments. Thus, in the primary market, the issuers have direct contact with the investors, while in the secondary market, the dealings are between investors and the issuers do not come into the picture. Secondary market can be broadly divided into two segments. Over-the-counter market, OTC market. OTC markets are the markets where trades are directly negotiated between two or more counterparties. In this type of market, the securities are traded and settled over the counter among the counterparties directly. Exchange-traded markets. The other option of trading in securities is through the stock exchange route, where trading and settlement is done through the stock exchanges. The trades executed on the exchange are settled through the clearing corporation, which acts as a counterparty and guarantees the settlement of the trades to both buyers and sellers. Trading. A formal contract to buy/sell securities is termed as trading. As defined above, trading can be done either in the over-the-counter OTC market or the exchange-traded market. Stock exchanges in India feature an electronic order matching system that facilitates efficient and speedy execution of trades. Clearing and settlement. Clearing and settlement are post-trading activities that constitute the core part of equity trade life cycle. Clearing activity is all about ascertaining the net obligations of buyers and sellers for a specific time period. And settlement is the next step of settling obligations by delivering shares by the seller and paying money by the buyer. While OTC transactions are settled directly between the counterparties, clearing corporation is the entity through which settlement of securities takes place for all the trades done on stock exchanges. The details of all transactions performed by the brokers are made available to the clearing house by the stock exchange. The clearing house gives an obligation report to brokers and custodians who are required to settle their money or securities obligations within the specified deadlines, failing which they are required to pay penalties. In practice, the clearing corporation provides full novation of contracts between buyers and sellers, which means it acts as buyer to every seller and seller to every buyer. As a result, the counterparty risk is substantially reduced for the investors. Risk management. In OTC transactions, counterparties are expected to take care of the credit risk on their own. In exchange-traded world, the clearing corporation, as defined above, gives settlement guarantee of trades to the counterparties, all buyers and sellers. This exposes the clearing corporation to the risk of default by the buyers and sellers. To handle this risk, the clearing corporation charges various kinds of margins. Most prominent among these margins are initial or upfront margin, peak margin, and mark-to-market (MTM) margins. Initial margin is a percentage of transaction value arrived at based on concept of value at risk philosophy, and MTM margin is the notional loss which an outstanding trade has suffered during a specified period on account of price movements. Various market participants and their activities. Market participants in securities market include buyers, sellers, and various intermediaries between the buyers and sellers. Some of these entities are defined in brief here. Market intermediaries. Stock exchanges. Stock exchanges provide a trading platform where buyers and sellers can transact in already issued securities. Stock markets such as NSE, BSE, and MSEI are nationwide exchanges. Trading happens on these exchanges through electronic trading terminals, which feature anonymous order matching. Stock exchanges also appoint clearing and settlement agencies and clearing banks that manage the funds and securities settlement that arise out of these trades. Depositories. Depositories are institutions that hold securities like shares, debentures, bonds, government securities, mutual fund units of investors in electronic form. Investors open an account with the depository through a registered depository participant. They also provide services related to transactions in the securities held in dematerialized form. Currently, there are 2 depositories in India that are registered with SEBI. Central Depository Services Limited, CDSL, and National Securities Depository Limited, NSDL. Depository Participant. A depository participant, DP, is an agent of the depository through which it interfaces with the investors and provides depository services. Depository participants enable investors to hold and transact in securities in the dematerialized form. While the investor-level accounts in securities are held and maintained by the DP, the company-level accounts of securities issued are held and maintained by the depository. Depository participants are appointed by the depository with the approval of SEBI. Public financial institutions, scheduled commercial banks, foreign banks operating in India with the approval of the Reserve Bank of India, state financial corporations, custodians, stock brokers, clearing corporations/clearing houses. NBFCs and registrar to an issue and share transfer agents complying with the requirements prescribed by SEBI can be registered as ADP. Trading members. Trading members or stockbrokers are registered members of a stock exchange. They facilitate buy and sell transactions of investors on stock exchanges. All secondary market transactions on stock exchanges have to be essentially conducted through registered brokers of the stock exchange. Trading members can be individuals, sole proprietor, partnership firms, or corporate bodies who are permitted to become members of recognized stock exchanges subject to fulfillment of minimum prudential requirements. Authorized person. Authorized person is any person, individual, partnership firm, LLP or body corporate who is appointed by a stockbroker or trading member as an agent to reach out to the investors scattered across the country. A stockbroker may appoint one or more authorized persons after obtaining specific prior approval from the stock exchange concerned for each such person. The approval as well as the appointment of authorized persons is for a specific segment of the exchange. SEBI had earlier allowed spread of subbrokership as well as authorized persons network to expand the brokers network. However, SEBI board in its meeting held on June 21, 2018 decided that subbrokers as an intermediary shall cease to exist with effect from April 1, 2019. All existing subbrokers would migrate to become authorized persons, APs, or trading members if the subbrokers meet the eligibility criteria prescribed under stock exchange bylaws and SEBI regulations and by complying with these regulations. Custodian. A custodian is an entity that is charged with the responsibility of holding funds and securities of its large clients, typically institutions such as banks, insurance companies, and foreign portfolio investors. Besides safeguarding securities, a custodian also settles transactions in these securities and keeps track of corporate actions on behalf of its clients. It helps in maintaining a client's securities and funds account, collecting the benefits or rights accruing to the client in respect of securities held, keeping the client informed of the actions taken or to be taken on their portfolios. Clearing corporation. Clearing corporations play an important role in safeguarding the interest of investors in the securities market. Clearing agencies ensure that members on the stock exchange meet their obligations to deliver funds or securities. These agencies act as a legal counterparty to all trades and guarantee settlement of all transactions on the stock exchanges. It can be a part of an exchange or a separate entity. Clearing banks. Clearing bank acts as an important intermediary between clearing members and the clearing corporation. Every clearing member needs to maintain an account with the clearing bank. It is the clearing member's responsibility to make sure that the funds are available in its account with clearing bank on the day of pay-in to meet the obligations arising out of trades executed on the stock exchange. In case of a payout, the clearing member receives the amount in their account with clearing bank on payout day. Merchant bankers. Merchant bankers are entities registered with SEBI and act as issue managers, investment bankers, or lead managers. They help an issuer access the security market with an issuance of securities. They are single-point contact for issuers during a new issue of securities. They evaluate the capital needs of issuers, structure an appropriate instrument, get involved in pricing the instrument, and manage the entire issue process until the securities are issued and listed on a stock exchange. They engage and coordinate with other intermediaries such as registrars, brokers, bankers, underwriters, and credit rating agencies in managing the issue process. Underwriters. Underwriters are intermediaries in the primary market who undertake to subscribe any portion of a public offer of securities which may not be bought by investors. They serve an important function in the primary market, providing the issuer the comfort that if the securities being offered to public do not elicit the desired demand from investors, they, underwriters, will step in and buy the securities. When the underwriters make their commitments at the initial stages of the IPO, it is called hard underwriting. Soft underwriting is the commitment given once the pricing is determined. The shares that devolve are usually placed with other financial institutions, thereby limiting the risk to the underwriter. Soft underwriting also comes with a clause that provides the option to exit from the commitment in the event of certain events occurring. Institutional participants. An investor is the backbone of the securities market in any economy as the one lending surplus resources to companies for their productive activities. Investors in securities market can be broadly classified into retail investors and institutional investors. Institutional investors comprise domestic financial institutions, banks, insurance companies, mutual funds, and foreign portfolio investors. Some of them are defined here in brief. Foreign portfolio investors, FPIs. A foreign portfolio investor, FPI, is an entity established or incorporated outside India that proposes to make investments in India. These international investors must register with the regulator, Securities and Exchange Board of India (SEBI) to participate in the Indian securities market. P-note participants. Participatory notes, P-notes or PNs, are instruments issued by SEBI-registered foreign portfolio investors to overseas investors who wish to invest in the Indian stock markets without registering themselves with the market regulator, Securities and Exchange Board of India. P-notes provide access of Indian securities to these investors. Mutual funds. A mutual fund is a professionally managed collective investment scheme that pools money from many investors to purchase securities on their behalf. Mutual fund companies invest the pooled money in stocks, bonds, and other securities depending upon the investment objective of the scheme, which is stated up front. A fund manager, with the help of a research team, takes all the major decisions in terms of which companies to invest in, the percentage of each stock in the portfolio, when to exit, and so on. Each investor owns units which represent a portion of the holdings of the fund. Diversification of investments is an important aspect of mutual funds investing. It helps in reducing the risk in investment for the investor. As a result, the investor is less likely to lose money on all the investments at the same time. Insurance companies. Insurance companies' core business is to insure assets. Depending on the type of assets that are insured, there are various insurance companies, like life insurance and general insurance, etc. These companies have huge corpus and they are one of the most important investors in the Indian economy by investing in equity investments, government securities, and other bonds. Like mutual funds, each insurance company also has designated people who are responsible for investment decisions. Pension funds. A fund established to facilitate and organize the investment of the retirement funds contributed by the employees and employers, or even only the employees in some cases. The pension fund is a common asset pool meant to generate stable growth over the long term and provides a retirement income for the employees. Pension funds are commonly run by a financial intermediary for the company and its employees, although some larger corporations operate their pension funds in-house. Pension funds control relatively large amount of capital and are some of the largest institutional investors. Venture capital funds. A venture capital fund refers to a pooled investment vehicle like mutual fund but with a mandate to invest money in enterprises that are in the early stage of development but with the potential of long-term growth. The longer gestation period and higher risk of failure make it difficult for such companies to access conventional sources of finance, such as banks and the capital markets. Venture capitalists bring managerial and technical expertise as well along with capital to their investee companies. Private equity firms. Private equity is a term used to define funding available to companies in the early stages of growth, expansion, or buyouts. Investee companies may be privately held or publicly traded companies. The term private equity includes venture capital firms. The money in the fund is contributed by investors, called limited partners, and invested and managed by the general partners. Some of the private equity funds are specialized funds with competence in a particular industry, stage of the company, or targeted deals such as funding buyouts. Hedge funds. A hedge fund is an investment vehicle that pools capital from a number of investors and invests that across the assets, across the products, and across the geographies. These fund managers generally have a very wide mandate to generate returns on the invested capital. They hunt for opportunities to make money for their investors wherever possible. In that sense, actually, the term hedge fund is a misnomer as these funds may not necessarily be hedged. Alternative investment funds. These are privately pooled investment schemes that invest in various asset classes such as real estate, private companies, commodities, and such other alternative investment assets. The term alternative typically includes all other assets excluding listed equities, fixed income instruments, fixed deposits, or collective investment schemes or investment platforms such as mutual funds, NPS, insurance plans that invest in these assets. In India, alternative investment funds, AIFs, are defined in Regulation 2(1)B of the Securities and Exchange Board of India Alternative Investment Funds Regulations 2012. It refers to any privately pooled investment fund, whether from Indian or foreign sources, in the form of a trust or a company or a body corporate or a limited liability partnership, LLP, which are not presently covered by any regulation of SEBI governing fund management like regulations governing mutual fund or collective investment scheme, nor coming under the direct regulation of any other sectoral regulators in India, IRDAI, PFRDA, RBI, etc. SEBI categorizes AIFs into three categories. Category 1 AIF. These refer to AIFs which invest in startup or early-stage ventures or social ventures or SMEs or infrastructure or other sectors or areas which the government or regulators consider as socially or economically desirable. These include venture capital funds, including angel funds, SME funds, social venture funds, infrastructure funds, etc. Category 3 AIF. These refer to those that use complex investment strategies including use of leverage and derivatives. Hedge funds, pipe funds, etc. are registered as Category 3 AIFs. Category 2 AIF. AIFs which do not fall in Category 1 and 3 and which do not undertake leverage or borrowing other than to meet day-to-day operational requirements are categorized under Category 2 AIFs. Various types of funds, such as real estate funds, private equity funds, funds for distressed assets, etc. are registered as Category 2 AIFs. Investment advisors. Investment advisors work with investors to help them decide on asset allocation and make a choice of investments based on an assessment of their needs, time horizon, return expectation, and ability to bear risk. They may also be involved in creating financial plans for investors where they help investors define their financial goals and propose appropriate saving and investment strategies to meet these goals. Employee Provident Fund, EPF. EPF is a scheme that is used to provide retirement benefits in the form of defined benefit schemes to employees of covered organization. Every employer is obligated to provide 12% of basic salary as contribution to the scheme, and equal amount is deducted from the employee's salary. The funds are deposited with Employees Provident Fund Organization, EPFO, which administers and manages the funds. The fund pays predetermined rate of interest, decided yearly, to the beneficiaries. The fund invests in debt instruments and equity instruments, but employees do not have any say in the investments or asset allocation of the fund. National Pension Scheme, NPS. This is a government-sponsored retirement scheme. Subscribers contribute regularly to the scheme, and on maturity, the funds accumulated in the scheme can be used to buy annuity products. Subscribers will also have the option to partially withdraw the funds at maturity. Corporate NPS schemes can be offered by employers in addition to other retirement benefit schemes. NPS offers various choices of funds, and beneficiaries can route it to the fund of their choice. Family offices. Family office refers to an organization that handles the wealth of a wealthy family. They typically take care of all aspects of financial management of the family, including investments, estate planning, and tax planning. They also take care of other activities such as day-to-day accounting of families' income and expenses and handling payments to vendors, household staff, etc. There are single-family offices and there are multifamily offices. Multifamily offices handle the finances for multiple families. Corporate treasuries. Companies and other business organizations may have surplus funds which they intend to use for potential future opportunities or to meet future obligations. The organizations would gain if these funds are temporarily invested rather than to let it be idle in their bank's current accounts. Large corporates have a separate treasury team that handles such investments of surplus funds. In case of other businesses, such as private limited companies or partnership firms, these activities may be handled by the regular finance team. Corporate treasuries, on account of their larger sizes, get opportunities to invest in many different types of securities. Smaller business, however, mostly park their funds through mutual funds. Retail participants. Retail investors include individual investors who buy and sell securities for their personal account and not for another company or organization. HNIs, or high net worth individuals, and UHNIs, ultra high net worth individuals, are individual investors who invest large sums of money in the market. Reserve Bank of India has also granted general permission to non-resident Indians, NRIs, person of Indian origin, PIOs, and qualified foreign investors, QFIs, for undertaking direct investments in Indian companies under the automatic route. Proxy Advisory Services firms. Proxy advisors advise investors in relation to exercise of their rights in the company, including recommendations on public offer or voting recommendation on agenda items. As investors may not be able to track shareholder announcements of all their investee companies or analyze each of the proposal in depth, the service of proxy advisors add value to them. Proxy advisors analyze voting proposals and how it affects the interest of the investors and eventually suggest how they should vote. Proxy advisors are typically engaged by institutional investors to advise them on matters that come for voting. Kinds of transactions. We may undertake several kinds of transactions in the securities market, ranging from immediate settlement to the distant settlement. Transaction types also vary based on transactions in the stock market or outside the stock market, called OTC trades. A brief description about different kinds of transactions is given below. Cash, TOM, and spot trades/transactions. Cash trades are the trades where settlement, payment, and delivery occurs on the same trading day, T+0, where 0 defines the time gap in days between trade day and settlement day. Cash trades in financial markets are unusual as most contracts are settled between 2 to 3 days from the date of trade, though Indian stock exchanges have gradually started moving for all stocks into T+1 settlement cycle. However, we see cash transactions in our normal day-to-day life all the time when we buy groceries, vegetables, and fruits from the market. TOM trades are the trades where settlement, payment, and delivery occurs on the day next to the trading day, T+1, where 1 defines the time gap in days between trade and settlement day. Some of the transactions in foreign exchange market, FX market, settle on T+1 basis. Spot trades are the trades where settlement, payment, and delivery occurs on the spot date, which is normally 2 business days after the trade date. Equity markets in India offer spot trades. FX markets globally, by default, offer spot transactions in the foreign exchange. Forward transactions. Forward contracts are contractual agreement between 2 parties to buy or sell an underlying asset at a certain future date for a particular price that is decided on the date of contract. Both the contracting parties are committed and are obliged to honor the transaction irrespective of price of the underlying asset at the time of settlement. Since forwards are negotiated between 2 parties, the terms and conditions of contracts are customized. These are over-the-counter OTC contracts. Example: a farmer agrees to sell his produce of wheat to a miller 6 months later when his crop is ready at a price that both counterparties agree today. This is an OTC executed forward contract. It can be settled in cash or result in actual delivery of wheat. The settlement terms, such as quantity and quality of wheat, the price and payment terms, reference benchmark in case of cash settlement of contract, etc., are decided by the counterparties at the time of entering into contract. These contracts carry counterparty risk if either of the parties in the trade fails to honor his side of the contract. Therefore, these contracts are generally entered between known parties and leans on informal protection mechanisms to ensure that the contract is honored. The forward markets in commodities in several parts of India are based on mutual trust and are functional despite the risks involved. Futures. Futures are standardized exchange-traded forward contracts. They are standardized as to the market lots, traded quantities, quality, and terms of delivery, delivery date, cash settlement, or physical delivery, etc. As these contracts are traded and settled on a stock exchange and the clearing corporation provides settlement guarantee on them, they are subject to stringent requirements of margins by the clearing corporations. Futures contracts are available on variety of assets including equities and equity indices, commodities, currencies, and interest rates. Example: wheat futures traded on the Multi-Commodity Exchange, MCX, of India has the following specifications among others. Trading unit: 10 metric tons. Minimum order size: 500 metric tons. Maximum position per individual: 5,000 metric tons. Quality: standard mill quality as specified by the exchange. Contract begin date: 21st of the month. Delivery options: physical delivery only. Delivery date: 20th of the month. Delivery center: exchange-approved warehouses. Options: an option is a contract that gives the right but not an obligation to buy or sell the underlying asset on or before a stated date and at a stated price. The buyer or holder of the option pays the premium and buys the right. The writer or seller of the option receives the premium with the obligation to sell or buy the underlying asset if the buyer exercises his right. Based on the type of contract, options can be divided into 2 types. Call gives the buyer the right but not the obligation to buy a given quantity of the underlying asset at a given price on or before a given future date. Put gives the buyer the right but not the obligation to sell a given quantity of the underlying asset at a given price on or before a given date. Options can be transacted both in OTC market and exchange-traded markets. Example: Arvind buys a call option on the Nifty 50 index from Salim to buy the Nifty 50 at a value of 11,000 3 months from today. Arvind pays a premium of 100 rupees to Salim. What does this mean? Arvind is buyer of the call option. Salim is seller or writer of the call option. The contract is entered into today but will be completed 3 months later on the settlement date. 11,000 is the price Arvind is willing to pay for Nifty 50 3 months from today. This is called the strike price or exercise price. Arvind may or may not exercise the option to buy Nifty 50 at 11,000 on the settlement date. But if he exercises the option, Salim is under obligation to sell the Nifty 50 at 11,000 to Arvind. Arvind pays Salim 100 rupees as the upfront payment. This is called the option premium or price of the option. On settlement date, if Nifty 50 is at 11,200, this means Arvind's option is in the money. He can buy the Nifty 50 at 11,000 by exercising his option. In this case, Salim earns 100 rupees as premium but loses ultimately as he sells Nifty 50 at 11,000 to meet his obligation when the market price is 11,200. On the other hand, if on the settlement date Nifty 50 is at 10,800, Arvind's option will be out of the money and expires worthless. There is no point paying 11,000 to buy the Nifty 50 when the market price is 10,800. Arvind will not exercise the option. Salim will pocket 100 rupees he collected as premium. Swaps. A swap in the financial markets is a derivative contract made between two parties to exchange cash flows in the future according to a prearranged formula. Swaps help market participants manage risks associated with volatile interest rates, currency rates, and commodity prices. Example. On a borrowing, borrower has to pay quarterly interest rate, which is defined as the treasury bill rate on that date plus a spread. This floating rate interest payment means that the actual obligation of the borrower will depend on what the treasury bill rate would be on the date of each settlement of interest obligation. The borrower, however, prefers to pay a fixed rate of interest. He can use the interest rate swap market to get into the following swap arrangement. Pay a fixed rate to the swap dealer every quarter. Receive T-bill plus spread from the swap dealer every quarter. The swap in this contract is that one party pays a fixed rate to the other and receives a floating rate in return. The principal amount on which the interest will be computed is agreed upon between counterparties, called notional of the trade. Only the interest rate on this amount is exchanged on each settlement date every quarter between counterparties. The borrower will use the floating rate that he has received from the swap market and pay the floating rate dues on his borrowing. These two legs are thus cancelled and his net obligation is the payment of a fixed interest rate to the swap dealer. By using the swap market, the borrower has converted his floating rate borrowing into a fixed rate obligation. Trading, hedging, arbitrage, pledging of shares. Trading. Trading or speculating is an active purchase or sale of an asset in the expectation of a gain from changes in the price of that asset over a short period of time. Traders or speculators seek to benefit from acting on information which bring about changes in prices. Their actions increase liquidity in the market. Traders or speculators typically leverage their trading activity with borrowed funds, which magnifies their gains as well as losses. Hedging. Hedging is an act of taking position in the financial transactions to offset potential losses that may be incurred by another position. A hedge can be constructed from many types of financial instruments, including insurance, forward/futures contracts, swaps, options, etc. A hedged position limits loss as well as gains, since appreciation in one position is squared off by depreciation in the other position and vice versa. Arbitrage. Arbitrage is simultaneous purchase and sale of an asset in an attempt to profit from discrepancies in their prices in two different markets. Buying a stock in the spot market and simultaneously selling that in the futures market to benefit from the price differential is an example of an arbitrage transaction. An important point to understand is that in an efficient market, arbitrage opportunities may exist only for short period or none at all. The existence of an arbitrage opportunity will increase buying in the lower-priced market, leading to a rise in prices, and increased selling in the higher-priced market, leading to a fall in prices, ultimately resulting in closing the gap and elimination of the arbitrage opportunity between the two markets. Pledging of shares. Pledge is an act of taking loan against securities by the investor. The investor is called as pledger and the entity who is giving the loan against the securities is called as pledgee. Securities held in a depository account can be pledged/hypothecated to avail of loan/credit facility. When dematerialized securities are pledged, they remain in the pledger's demat account, but they are blocked so that they cannot be used for any other transaction. Pledged securities can be unpledged once the obligations under pledge are fulfilled. In case of default, the pledgee can invoke the pledge. Dematerialization and rematerialization of securities. Dematerialization. Dematerialization is the process of converting securities held in physical form into holdings in book entry electronic form. In demat form, one investor's shares are not distinguished from another investor's shares, and these shares do not have any distinctive number, folio number, or certificate number. SEBI's regulations require a company making a public issue of shares to enter into an agreement with all the depositories to dematerialize its shares so that investors can be given the option of holding the shares in dematerialized form. Rematerialization. Rematerialization is the reverse of dematerialization and is the process of converting securities held in electronic form into physical form. On request of investors, securities on rematerialization are allotted in physical form with distinctive numbers in place of the securities held electronically in book entry form with a depository.